Welcome to Electrified. It's your host, Dylan Loomis. Quick shout out to my newest patrons, Gary and Joanne Y and YoLS. Thank you for choosing to support the channel. First up today, we're going to spend a few minutes talking about what I believe is completely unacceptable from those in power. This charade has been going on for far too long, and the American people and people globally need to understand the game that is being played by those in power. What put me over the edge was what the White House said about inflation last night. I'm not going to make this political at all. I'm just going to lay out the facts and let you draw your own conclusions. Jen Psaki said, "We expect March CPI headline inflation to be extraordinarily elevated due to Putin's price hike." It's simply disheartening to me to watch the US government place blame on anyone and anything other than themselves. They simply will make these statements and expect the American people to just accept whatever ridiculous statements they say and to take it as the truth. However, if we look at the data, here's the most recent CPI report. Guys, Russia invaded Ukraine at the end of February. The inflation rate for all items was already approaching 8% year over year. The target rate that the Fed has set for inflation has been 2%, and the blue line has been elevated over that since March of 2021. So long before anything happened with Russia and Ukraine, inflation was becoming a real problem. A quick fun fact for you that, yes, has been debated. However, many people believe that commodity price inflation is actually a better indication of true current inflation than the CPI, because it takes a few months for these commodity prices to trickle down through the economy to actually hit consumer retail prices. However, the main takeaway from this paper is that it's the turning point in commodity price inflation that most frequently precedes the turning point in consumer price inflation. So let's keep an eye on that in the weeks and months to come. Now we'll get into the real and fake inflation numbers data. This website is shadowstats.com. Essentially, it's showing us what the real CPI would be today if the measurements weren't changed many times over the years. This chart is showing us what the CPI reading would be today if we were still using the 1990 base metrics. We're just going to focus on the blue line and the red line. The red line is the official CPI-U for urban reported data, and the blue line is how it would look if we were using the 1990 base metrics. The simple takeaway here is that had all of these changes to the way the CPI is calculated not been made, the CPI report would essentially be about double from what's being reported today. And here we have a similar chart going back one more decade using the 1980 base metrics, and you can see if today's CPI reading was calculated using the 1980 metrics, current inflation would be over 15%. Now the question becomes, why would the government want to artificially lower the CPI data? Reason number one, when inflation is lower or under control, the government can keep interest rates lower, which spurs more economic activity, leads to more growth in the stock market, and overall Americans are happier and pleased with the administration. Reason number two, the CPI and GDP have an inverse relationship. So if the CPI reading is lower, that's going to yield a higher real GDP figure, which is one of the main indications of the strength of the US economy. Once again, something that the government would of course want. So as simple as I can make it, how does this work? Real GDP is nominal GDP divided by R, where R is the GDP deflator. Essentially, the CPI reading will adjust or deflate some of the nominal GDP figures. So nominal is just the regular rate, and then the real GDP is actually adjusted for inflation. So when calculating for real GDP, R is going to be based on the CPI rating. If R is higher, aka has a higher CPI rating, when you divide by a higher number, that's going to give you a lower output, meaning a lower real GDP. So once again, another incentive for the government and people in power to have lower CPI readings. This is another way for the government to make the economy look like it's stronger than it really is. And a third reason why the government likes lower CPI readings is because many government expenditures are actually tied to the CPI reading. Take, for example, Social Security that has COLAs or cost of living adjustments. These COLAs are based on increases in the CPI. So if we have lower CPI readings, they can actually pay out less in Social Security because the COLAs will be lower. And it's not just Social Security, it's tips or Treasury inflation protected securities and many other expenditures as well. That brings us to how people in power are manipulating this data. Historically, the CPI was tracked using the cost of goods index. basically a basket of goods that had a price, and over time, those prices of those same goods were tracked. However, there was then a shift or a change to a cost of living index. The simplest way to explain this is it deals with substitution. People in power are now making very subjective decisions about what consumers can buy instead of those previous basket of goods. Here's a simple example. Let's say a bottle of Crest toothpaste costs $5 in that original cost of goods index, but that bottle increases in price to $10. Now that the CPI is being tracked using this cost of living index, people in power are saying, well, consumers can still buy a bottle of Crest toothpaste that, hey, it still only costs $5, so the inflation for this bottle of toothpaste is actually zero. Now, I don't know about you, but I personally prefer that the government not make these very subjective decisions that effectively veil or mask the deterioration of my quality of life. And sadly, this goes much further. Look at this and how it impacts your and my tax situation. From the tax and jobs cut just a few years ago, many people talked about the lowering of the tax rate, which everybody was cheering about and enjoying, but nobody was talking about this. I don't have time to explain what the chained CPI is. Just remember the red line is about 9% lower, and that's the chained CPI or C-CPI. All you need to know here is that people in power are choosing this lower version of the metric, the chained-CPI, to index your tax bracket. So what does that actually mean? As I just showed you, this metric implies smaller price increases in the CPI reading. This means that the tax brackets will have smaller adjustments, meaning more individuals will fall into the higher tax brackets and ultimately pay more taxes. And don't forget Social Security. If those payments are also linked to the chained consumer price index, Social Security payments will also increase at a slower rate. And you guessed it, the government has elected to use this lower metric. So I personally just don't think it's a surprise that the government is making the decision that seems to be aligned with its best interests, not the best interests of the American people. And it's pretty apparent that over time, the gap between these two metrics is widening. As you can see in 2010, the difference was about 3%. And fast forward to today, as I mentioned, the difference is closer to 9%. And what does all of this mean for Tesla? Well, it's a lot more than just higher input costs and higher prices for Tesla's products. It goes more into the required rate of return for investors. If inflation is 10%, then investors are going to be looking to invest their capital in places where they can exceed at least 10% to keep up with the cost of inflation. But one of the most impactful outcomes for Tesla stock is the way that analysts on Wall Street and big money use discounted cash flow analysis. When interest rates rise, that means the opportunity cost of investing in Tesla is higher. For example, if I can get 5 or 6% on a risk-free government bond, that lessens the attractiveness of Tesla, relatively speaking. And it's that discount rate that Wall Street and big money will use to discount the future value of cash flows back to today's values or the net present value. And simply put, it's that determination of the discount rate that includes the risk-free rate. So when inflation is happening and interest rates are going up, the risk-free rate will also increase, thus increasing the discount rate, which means you're discounting those cash flows back using a higher figure, meaning in today's terms, it's actually worth less, thus reducing the attractiveness of said investment. So maybe I'll dive into this further on Patreon, but the point is draw your own conclusions and remember there is far more nuance to the conversation than just meets the eye. So let's close today by racing through a few quick news items. This was shared by Alex on Twitter. Tesla doubling up second place in Q1 for German BEV sales. Drive Tesla Canada and Ryan from Ride the Lightning apparently got their hands on an internal email at Tesla, and the new standard range all-wheel drive Model Y with around 279 miles of range is set to cost $59,990 or $3,000 less than the long-range variant, which by the way has 50 miles more range. So it's not the best price in my opinion. It's only 5% cheaper in terms of dollar cost, but it has 18% less range than the long-range variant. So I'm not entirely sure what Tesla's strategy is here, but I will withhold my final judgment until we get all of the detail and the Tesla configurator is live, which hopefully, and word on the street is saying will be in the next few weeks. There's a reservation tracker out there for the Cybertruck that is saying there are around 1.4 million million reservations. It goes through some calculations in terms of potential revenue for Tesla. I'm drawing zero conclusions from that because we have no idea what the actual price is going to be. I'm very confident it's going to be much higher than what they announced. I will, however, link this tracker below if you want to take a look. Lucid has announced its Grand Touring Performance version with 446 miles of range, costing a whopping $179,000, set to follow the regular Grand Touring version. Lucid said in late February it had built around 400 vehicles and it's expecting to deliver between 12 and 14,000 vehicles in 2022. And Tesla is set to take over a 100,000 square foot facility in St. Pete, which is pretty close to where my family and I like to vacation at times. This is set to be part showroom, part service center, part parts center, and part storage facility, so a multi-use facility for Tesla that will save many customers in this area from traveling across the bridge to Tampa Bay. So here's the map for those familiar with the area. Here's where the location is. They're taking over an old furniture warehouse facility, but no timeline has been given for construction on the site. And last up for today, Bosch has made a nice acquisition of a software AI company working on self-driving called 5. Let's not forget that Bosch has teamed up with Volkswagen and its Cariad, or its software division, where they're working on its level 3 driving and eventually working toward autonomy. So this acquisition could be an indirect benefit to Volkswagen and Cariad. That'll do it for today though. Please take a second to like the video if you did. Hope you guys have a wonderful day, and a huge thank you to all of my Patreon supporters.